So we are going to start with Chapter 4. And this, we've gone through a lot of steps so far in the accounting cycle. We've learned how to analyze transactions. We've learned how to journalize them. We've learned how to post them to their various accounts. We've learned how to create a trial balance. We've also learned how to create adjusting balances and then to come up with adjusting trial balances. Then we've created our financial statements. We've got one thing left to complete the accounting cycle. One thing. Okay? So this is what we're talking about, this whole accounting cycle. We're going to learn something called closing entries. We've learned how to make the correct journal entries to analyze and record. Then we've learned how to make adjusting entries. Now we're going to do something called closing entries and learn how to prepare reversing entries. So this basically allows us to truly complete the entire accounting cycle. What are closing entries? Closing entries are going to be journal entries at the very end of the accounting period. So what we've done, guys, we've gone through the period, we've created all these transactions from economic events, we've created our trial balance, then we've done our adjustments, then we've created all our financial statements. Now what we need to do is say this period's over with. We need to clean up our books and zero out these revenue and income and expense accounts that we need to zero out so we can start over the next period. Make sense? So that's really what we're going to do, is we're going to finish it off so we can start fresh the next period. So two purposes in the closing entries is to set the stage, clean out for the next period. The closing entries are going to zero out or clear our revenue accounts, our expense accounts, and also our withdrawal accounts of any balances they have, so we can start fresh or at zero for the next period. Make sense? And then as a result of this, the other thing we're going to do is really summarize the revenues and expenses by throwing them into this account called the income summary account, which ultimately throws them into the owner's capital account. You know how we always say the owner's capital starts with the beginning balance, and then we add our income, net income, we subtract our withdrawals, and then we have an ending capital balance? This summarized revenue and expenses is basically going to create a journal entry so our income goes into our capital account and our withdrawals reduce our capital account. So our ending capital balance is going to equal what we showed on that owner's equity statement, what it should be. So basically, how we're going to do this is zero out our revenues, zero out our expenses, and zero out our withdrawals. This slide here shows us really how we do it. If you look here, we know expenses always have a normal debit balance. But to zero out the expense account, we're going to credit it. And that's going to zero it out. We never zero out assets or liabilities. They stay current from each year. Think of your own bank account, guys. At the end of December 31st, if you have $3,500 sitting in your account, on January 1st, do you still have $3,500 sitting in your account? You better. But with revenues and expenses, we record that for a certain period of time, over a period of time, and then we want to start fresh. So that's why we need to zero them out. So to zero out our expense accounts, we're going to credit them to wipe them out. So if we credit our expense accounts, we need to debit something. And the something we're going to debit is this temporary account we're going to call income summary. We're just creating it at the end of the accounting period. Then, think of our revenue accounts. They normally have credit balances, but to zero out our revenue accounts, what are we going to do? We're going to debit it. And if we debit the revenue accounts, we're going to credit that to income summary. Then, if we have a normal net income balance, which would end up being a credit to the income summary, to zero it out, we're going to debit it. So our income summary balance is actually totally zero. It's wiped out. And we credit our capital to increase. You know how we have always said net income increases capital? Well, that's how we're increasing our capital ultimately, is we are going to wipe out this temporary account called income summary by debiting it, and we would credit capital to increase it. The other thing we say a lot is withdrawals decrease our capital. So if we want to wipe out our withdrawal account, it has a normal debit balance, but to zero it out, we're going to credit it, and we're going to debit that to the capital account, because a withdrawal decreases owner's equity. So we're going to go through this whole process. So basically, what we need to understand is there are some of these accounts that are permanent accounts. Permanent accounts we never zero out. Like I said, think of it. If on December 31st your balance is X, it better be that on January 1st. We're not zeroing that stuff out. I wish sometimes my mortgage would get zeroed out, but it doesn't. If I owe $100,000 on December 31st, I still owe $100,000 on January 1st. Those are permanent accounts. We don't play with those. We don't play with anything, but we don't alter that. But the revenue and expense accounts we call temporary accounts. We use them each period and we wipe them out to start new again. Those get zeroed out each year or each period, and they ultimately flow into income summary, and that income summary account ultimately flows into the capital account. Okay, so let's learn to do all this. To close the various accounts, we're going to close the credit balances on the income statement. Credit balances would generally be revenue accounts, right? So we're going to close those credit balances by debiting them and crediting income summary. We're going to close any debit balances, which are generally expense accounts, and we are going to zero those out, and the entry we're going to use will also go right to income summary. Then that income summary balance we have is ultimately going to be closed out to the capital, so it zeros. And then any withdrawals that we have are going to get closed out too and go to capital. So basically, all we're going to do is get rid of a bunch of those trial balance accounts down at the bottom. So let me just show you real quick. Do you see let's just look at this trial balance. Do you see after IBEL capital, you then have IBEL withdrawals, revenues and expenses? The closing entry is going to wipe all of these temporary accounts out so we can start fresh again. None of these are going to get wiped out. The withdrawal down are going to be zeroed out.
The top part is the asset
and the liabilities.
and the liabilities.
and the capital account.
So, what do we call those?
Those are balance sheet accounts, permanent accounts.
Balance sheet.
So the balance sheet will never get zeroed out. It's only the withdrawals and the income statement accounts we're going to want to zero out. So basically what we're going to do is, let's look at this adjusted trial balance here. Do you see here? We've got cash, accounts receivable, office supplies, prepaid rent, office equipment, accumulated depreciation. All those make up the portion of the asset section of the balance sheet. Then we have accounts payable, unearned design revenue, and wages payable. Those are liabilities. Then we have J Blue Capital. That's the capital account. It's going to be the J Blue withdrawals, the design revenue, and all those various expense accounts we are going to close. Okay? So let's look at how we do this. Yes?
But we may occur those next month as well.
We will occur them next month.
Yes.
But we want to zero them out so we can start fresh. Okay? So the way in which we handle this is we're going to take our revenue from the previous, let me just get back here, from here. Do you see how our revenue is at $13,600? Do you see how we are going to debit our design revenue account, because that will zero it out, and we're crediting it to income summary, and this closes out the revenue account. We're going to do the same with every single expense account. They normally have a debit balance, but we are going to credit every one of those and zero them out and put the total to the income summary. So as you see here, this income, so we want to zero out our revenue accounts, we want to zero out all of our expense accounts, and as you see here, we've got a credit to our income summary of $13,600 and a debit of $96.40. What is a credit of $13,600 and a debit of $96.40? What's the new balance there? Wouldn't it be a credit of $39.60? But we then are going to want to zero out the income summary account. So to do that, we have to debit our income summary for $39.60 to zero it. And look what happens. If we debit our income summary for $39.60, we offset it with a credit to J Blue Capital for $39.60. Do you see when we make net income, we increase our capital account? This ultimately, like what we've been talking about, is playing out. As a company makes net income, it ultimately increases the capital of a company. And then also, when we have withdrawals, when an owner takes money out of the account, it reduces the capital account. So when we close out our withdrawal account, we zero it out, we're going to offset it to J Blue Capital to reduce our capital account. If you think about it, we take money out of the business, we have a right to do that, but the amount of capital that owner has in the business now goes down some because he took it out. Make sense? So let's look at this, guys. On July 31st, design revenue of $13,600 credit balance, that's what normally revenue is, a credit balance, it gets closed to income summary. The journal to close the revenue account basically decreases the account design revenue. You know, it debits design revenue, and it increases the account called income summary. So as you see here, if we started with a design revenue has a balance of a credit of $13,600. To close it out, we're going to debit design revenue, but the corresponding entry is going to be a credit to income summary. Then, so you can see debit to design revenue, a credit to income summary. This just mainly closes out our revenue account to zero. Okay? Then, design revenue has a zero balance in revenue, so we can get ready for the next period. So, as you see here, do you see how up until then, we had a credit balance of $13,000 sitting in this account. To close this out, we debit that account. You see now the balance is zero? But the corresponding entry we make then credits it to an account called income summary. Then we got to do the same with the expense accounts. We need to close out all the expense accounts. So think about it. All of these expense accounts normally have a debit balance. But to zero them out, we're going to credit each one of them, and our offsetting debit is going to be a debit to our income summary of $96.40. So if you see here, by crediting each one of these expense accounts, we zero them out. And our debit is to this income summary, $96.40. This then closes all the expense accounts. So then, all our expense accounts now have a zero balance. So you see now, by closing them, balances are all zero. But our income summary account still has it's got a net credit balance of $39.60. But we want to close that one out now too. So now, this $39.60, we want to zero out, but we always zero it to the capital account. So by closing out this income summary, debiting it is going to zero it out. We're going to offset it to a credit to J Blue Capital for $39.60. So you see, to zero out the income summary account, we debit $39.60 income summary, and we're going to credit J Blue Capital a credit for $39.60. Does that make sense? Now the income summary has a zero balance, and we're almost ready to be done. So we zeroed out our income summary, and we now have a new balance in our J Blue Capital account, don't we? $43,960. But we have one more thing we have to do. Since J Blue withdrew some money, we have a balance sitting in our withdrawal account of $2,800. We now want to zero out that withdrawal account, to zero it to start the next period. So what we're going to want to do is to zero out our withdrawal account. We are going to credit what we call the J Blue Capital withdrawal. It doesn't show withdrawal there. And we're going to debit our owner's capital account, because that reduces the capital we have in this account. So as you see here, J Blue Capital gets debited, the withdrawal account will get credited. Now, withdrawals has a zero balance, so we're ready to start the next period. Ready to go? Make sense? So as you see here, now our withdrawals are zeroed out, our new balance is zero, and the way we zeroed it out is we debited it to JBlue Capital. So now we have a true ending balance for JBlue Capital of $41,160. After all those closing entries have been posted, we are ready to start the next period. The revenue, the expense accounts, and with the withdrawal accounts are all what we call temporary accounts, and now they all have zero balances. The owner's capital account's been altered because if it's got net income, if the business had net income this period, the capital account gets increased, doesn't it? If it had a net loss, the capital account's going to get decreased. And if there were withdrawals, the capital account's going to get decreased. So now we're going to show something called the post-closing trial balance. The nice thing about this post-closing trial balance, the only thing you're going to see are accounts that are in a balance sheet. Because anything to do with the income statement isn't in here anymore. We zeroed it all out. So do you see when we always say with the capital owner's equity, we always start with the balance of JBlue Capital at the beginning of the period, and then we add our adjustments? Now that we're done with all of our closing out, this JBlue Capital is truly the ending balance and will begin the next month as the beginning balance. We have cleaned up and we've done everything to transfer our income and any withdrawals into JBlue Capital, and we have a new balance in that account. So the post-closing trial balance will only show you the permanent accounts. And what are permanent accounts? Permanent accounts are those that are just in the balance sheet. That's it. So I'm going to stop right there. We're going to do problems. So everything that we've learned can make some sense. Y'all ready for that? Of course we're ready, Nancy. So, let's just say in SE3, assume that at the end of the accounting period, there are credit balances of $3,400 in patient services revenue and $1,800 in laboratory fees revenue. So I'm going to create something for you, okay?
You love Excel, don't you?
I do. Okay, let's just say so, which is that first account called? It's a revenue account. What is it called?
Patient service.
Patient service revenues. Okay? And the other one was called?
Laboratory fees revenue.
Laboratory fees revenue. Okay. So, what did patient services revenue have?
3,400 credit.
Okay. And lab fees?
1,800.
So let's talk about this, guys.
Oh wait, I gotta go back to this.
So if we want to begin the closing journal entry process and we want to zero out our revenue accounts, What are we going to do to zero out this revenue account?
The patient service, you're gonna debit it.
We're going to debit it, $3,400, and now our new balance is going to be zero, right? And think of this, if we want to zero out lab service fees, what are we going to do? $1,800, and we have a new balance of zero. So let's just pretend we're going to do a journal entry. Our journal entry to close these accounts would be patient services revenue, debit of $3,400, lab fees revenue, debit of $1,800. What are we going to credit? Income summary, a credit of,
52.
thank you, $5,200. So here, $3,400, lab fees, debit of $1,800. Here, we're going to have a credit of $5,200. Does that make sense? Now,
They want us to do?
what?
That's what they want us to do?
Prepare the required closing entry. So basically what they would want us to do in this situation would be a debit to patient services revenue of $3,400, a debit to laboratory fees revenue of $1,800, and a credit to income summary of $5,200. So I was kind of showing it two ways to help you visualize how the accounts get zeroed out. Does that make sense?
Yes, it does.
Okay, let's take the next one. The next one says, assume that debit balances at the end of the accounting period are $1,400 in rent expense, $1,100 in wages expense, and $500 in other expense. So, guys, I'm just going to rent, wages, and other.
I'll do the other first. You gotta do the debit first.
So, right now we have rent expense, wages expense, and other expense. What does our rent expense say?
$1,400,
Okay, our wages
$1,100,
and other.
$500.
So let's just think about this. Bring down my income summary here to show what we've already done. Okay? So we want to zero out our rent. So we're going to credit it $1,400. We're going to credit wages $1,100. We're going to credit other $500. And if we credit those $3,000,
We're going to debit.
we're going to debit income summary for $3,000.
Yes.
So look at this. It would be income summary is our debit of $3,000. We're going to credit rent expense, $1,400. Wages expense, $1,100. Other expense, $500. You see what we're doing? We're closing out these temporary accounts. So do you see right now we have an income summary? What is our new balance?
credit of 2,200.
That's our new balance, isn't it? I'll just call it balance 2,200. Right?
Great.
What's going on, Celeste?
The reason we're subtracting the reason we got the 52 on the credit and the 3,000 is because we debited all the others and then we zeroed them out by credit. And then the reason that we take the 52 and the 3,000 is because they're all part of the withdrawal and the lower area that we don't want to carry over to next month.
Correct, they're temporary accounts. Exactly.
Sorry.
No, you know what? You're saying it out loud, everyone else is thinking it, okay? No. Next, assuming the total revenues were $5,200 and total expenses were $3,000, prepare the journal entry to close the income summary account to the P-Meta capital account. The accounting period ends December 31st. So let's go here and look. We've done this, guys. We have $5,200 in a credit. We have $3,000 in a debit. Our new income summary balance is $2,200, isn't it?
So you have to debit that, and then you have to credit the Mecca or whatever it is. What's his name? Meta Capital.
Whatever, Meta capital.
Yeah. Close enough.
So let's just think of this. We do have this new balance of 5,200 or 2,200. If we want to zero out our income summary, what are we going to do? We're going to debit it, 2,200. And what are we going to do with Meta Capital? Credit it, 2,200. So look at this entry. Our income summary gets debited 2,200, and then Meta Capital gets credited 2,200. Do you see then that zeroes out our income summary account, which is also a temporary account. We're just using it to clean up the books.
Can we like that just to clean up books?
What?
To clean up books?
To finish the period.
Yeah, oh, okay.
Yes, Celeste.
Then does that 2,200 increase his Meta's capital?
Yes! Do you see how it's increasing his capital account? Because think about it. What we've done is we've taken the revenue minus the expenses, which really ended up showing net income of $2,200 for the period. And we're taking that net income and increasing his capital account. Just like the statement of owner's equity does, doesn't it? Make sense? Okay. Now, SE4. No, let me do.
We did that.
Let's do E1A. E1A. This gives us an income statement. Hamilton Realty's income statement accounts at the end of its fiscal year, December 31st, follow. So it tells us the commission revenue and the various expenses, and it tells us we have net income of $97.90. Our job is to prepare the required closing entries. Lewis Hamilton is the owner. So I'm going to have you start with closing out the revenue account. And then after we close out the revenue account, I want you to close out the expense accounts. Okay? And then whatever the balance is in income summary, we're going to close to capital, the Lewis Hamilton capital account. So take a moment and try it on your own, but what I'm doing is I'm going to put the answer up here. So that way you don't get stuck. Don't let yourself get frustrated. Here are the closing entries here. See what I'm saying? So try to do it, guys.
That's the word, income summary.
Okay? Excuse me one sec. Yes.
Where did we get the 99790?
Okay, good question. Let's look at this. So as you see here, we're closing out the revenue and the expense accounts. So the first thing we're going to want to do is close out the revenue accounts. We know that commission revenue has a normal credit balance. So to close it out, we need to debit it to zero it out. So the first thing we're going to do is we are going to debit commission revenue, $25,620, and we're going to credit income summary, $25,620. Then we're going to get all of our expense accounts closed out. Expense accounts have a normal debit balance. To close them, we're going to need to credit them. So we know our debit is going to an income summary account. And the debit balance to income summary is going to be the total, which would be $15,830. And that's the total of all of the expense accounts. So what we'll do here is we'll debit income summary, $15,830, and we'll credit all of our different accounts. These zero out our expense accounts. Then the next thing we do is figure out what is our balance in our income summary account going to be. The balance is $97.90, which is the identical number as net income, $97.90. So we are going to then zero out this income summary account and flow it over to our capital account. This is why the net income of a company increases the capital account. Does that make sense? Mm-hmm. So basically, in doing this, the income summary, we debit $97.90 and we credit L. Hamilton Capital for a credit of $97.90. Now, I want to look at another one. Let's just see. So let's look here at look at problem 1. You should be able to get that on your worksheet, work papers. Selena's Trailer Rental rents small trailers by the day for local moving jobs. Its adjusted trial balance at the end of the current fiscal period is shown here. So basically, we see the adjusted trial balance. It's telling us, based on this information, we need to record closing entries. The closing entries we record relate to only the temporary accounts. We will never touch any of the permanent accounts. We'll only close the accounts that deal with D. Anatoli withdrawals and go down. That's it. But there's a certain order that we use to close accounts. The first thing we do to close accounts, which account are we going to close first? Yes. So do you see here that we are going to show we have a credit to trailer rental revenues for $91,092, don't we? So what are we going to want to do? We're going to basically go and debit trailer rentals revenue for $91,092, and we're going to credit income summary for $91,092. That's the first step in closing these accounts. Then, what's the next step we're going to do?
We're going to do income summary, which will total, income summary will be the total of our wages, insurance, supplies, depreciation.
Perfect.
Expenses.
We're going to zero out all of our expense accounts. Perfect. So we're going to take exactly what you said. All of our other, wages expense, insurance expense, supplies expense, depreciation expense for trailers, other expenses. The way we close those out is exactly what Celeste says. We debit income summary and we credit each one of those accounts. And you'll see, try it on your own, but then you see how the total of income summary should be $75,136. Now what we're going to do, after we've closed out the revenue accounts and we've closed out the expense accounts, now we have to close out the income summary. And the income summary account is basically going to be the net income for the period, because net income equals revenues minus expenses. So to close out the income summary, we're going to figure out what the balance is, and then to zero out the income summary, we're going to do the adjusting debit or credit. If it's net income, it's always going to be a debit to income summary, because we're going to increase our capital account, right? We're going to increase our capital, a credit of $15,956. Then, if we look here, The last thing we're going to do is take the withdrawal account, which is a temporary account, and zero that out. If D. Anatoly Withdrawals has a debit balance of $14,400, what are we going to do to zero it out?
Before you're gonna credit that.
We're going to credit it, and then where do we do the debit to Anatoly Capital? We debit $14,400 because that is decreasing our capital account. Remember, withdrawals will always decrease our capital account. Okay?
Where do you get these names from?
I don't get them. I think they try to be politically correct, if you know what I mean. Now it says to us, if closing entries were not prepared at the end of the accounting period, what would happen in the next accounting period?
Well, one thing would be that he wouldn't have close to 16,000 added to his capital.
Correct. Because think about it. We like to know what the income is for a period of time. And so if we didn't do these closings, we just continue it. So instead of recording 1 month at a time or 1 quarter or 1 year, we'd be recording 2 years.
Right.
That would be goofy.
And the other thing is that the rental revenue, if he didn't close that out, wouldn't that give somebody a much higher value of this business?
Well,
The income would show over a longer period of time than is really required or is correctly by GAAP. We're supposed to record events based on periodicity, certain periods of time. And so it would just be continuing it instead of recording it for a month or a quarter or a year.
But the more entries you have, the bigger your possibility for a mistake.
Always. Now, I am going to take some time, and we're going to do P2 right now. Now, just so you know, I am going to have several lectures online. I'll try to get them online before Saturday because I know that's when you like to work. There are some aspects to this chapter I still want to cover, but I don't want to move on until we have this firmly cemented. Okay? And I probably will next week do a summary like I did this week too. Okay? So can we do P2 or are y'all ready to go?
Oh,
No, we can just read
I thought it was maybe more of a lecture.
Not yet.
Okay.
Carlton Tennis Club's adjusted trial balance at the end of its fiscal year shows us all this stuff. Okay? We are going to prepare T accounts. And we're going to enter the balances for all these revenues and expenses and capital and withdrawals. Okay, so let's do that first. So if you go, and I'm going to show this, you're going to start with these various T accounts. So you see the first one should be, I don't know if you have them on there, but J. Cogis Capital. You see it on there?
Yeah.
And start with the balance. What does the balance on the trial balance show J. Cogis Capital to be?
$471,150.
$471,150. So you are going to go to that T account and show a credit balance of $471,150. It's the first thing you're going to do. That's all I want you to do there. Next, $471,150. Next, go and find the trial balance of J. Cogis withdrawals. It should be a debit balance of $54,000. Okay?
Wait. I see 4,000.
54.
Oh, I'm sorry, I thought that was a dollar.
I knew you were thinking that. Then you are going to, your next one will be income summary, but there's nothing on there yet. Then your next one is going to be revenue from court fees, and go and look at your trial balance, and you should have a balance in your revenue from court fees of a credit balance of $678,100. Do the same with revenue from locker fees. You should put in your balance, which is a credit balance, of $9,600. Then, all of your various expense accounts, create the balances shown on your trial balance here. So your wages expense should have a beginning balance of a debit of $351,000. The maintenance expense should have a debit of $51,600. The advertising expense should have a debit of $39,750. Utilities expense should have a debit of $64,800. Supplies expense should have a debit balance of $6,000. Depreciation expense should have a debit balance of $30,000. Depreciation expense equipment should have a debit balance of $12,000. The property tax expense should have a debit balance of $22,500. And miscellaneous expense should have a debit balance of $6,900. So that's the first thing you need to do. So I'm going to put these up here, but just what I don't want you to do is enter any journal entries yet. I just want you to fill in the balances, okay?
And I leave supply expense.
Asks us to enter the 4 required closing entries into the T accounts, labeling the components A, credit balances, B, debit balances, C, income summary, and D, withdrawals as appropriate. So what is the first entry we're going to make?
Debit.
A debit to what?
What's his name? Cogis Capital?
Let's think of the first thing we're going to do is clean up our revenue, zero out our revenue accounts.
Okay, yeah.
Okay? So let's zero out our revenue accounts, and what we're going to do is we're going to go to our 2 revenue accounts, revenue from court fees and revenue from locker fees that have credit balances. We want to zero them out, so we're going to make our the entry at the closing entry in A. We're going to show June 30th, and we're going to take that exact balance and debit it because we want to zero it out. So we would show a revenue from court fees, a debit of $678,100, And we would also show in revenue from locker fees, the closing entry A, a debit of $9,600.
I see.
And we are going to have the corresponding credit to income summary for the total of these two accounts. So if you go up here to income summary for the total, you're going to have A, June 30th, $687,700 is the total of those two accounts. Because we're taking the $678,100 plus the $9,600, totals are $687,700. Does that make sense? The first thing we always do with closing entries is to zero out revenues. That's the first thing. Now, the next closing entry is going to be listed as a B. We are going to zero out all of our expense accounts, and we're going to close those expense accounts into income summary, which means every one of our expenses should be zeroed out, which means we credit them to zero amount. Then you're going to take the total of all those and debit it to income summary. So go through each one of those and zero them out. And basically what happens is we will credit wages expense for $351,000. Make sure we do a B entry, the closing entry, label it B, June 30th. We will credit maintenance expense for $51,600, labeled B. The same with advertising expense will be a credit of $39,750. The utilities expense has a credit of $64,800. Then supplies expense has a credit of $6,000. Next, depreciation expense for the building has a credit of $30,000. Next, depreciation expense on equipment has a credit of $12,000. Next, property tax expenses has a credit of $22,500. Miscellaneous expense has a credit of $6,900. We're going to take all of those accounts that we have just zeroed out and total them. And we're going to place our debit in income summary. And that number should be $584,550. We've closed out the revenue. We've done the journal entry to close out the revenue. We've done the journal entry to close out all the expenses. What is the next journal entry we're going to do? We close out the income summary account. So we see in the income summary, we see a credit of $687,700, and we also have a debit of $584,550. We want to close that out, which means we're going to close it out by debiting 103,150, debit to the income summary, and our corresponding account in this journal entry is going to be the capital account, J. Cogis Capital, for a credit of 103,150. Remember, net income increases the capital account. So we now have closed out our income summary by closing that income summary out to J. Cogis Capital, which is the C entry of 103,150, a credit balance. The last entry in closing out the accounts is to close out the withdrawal accounts. We have right now a debit to withdrawals of $54,000. To zero that out, we're going to credit those withdrawals and zero it, and we're going to debit J. Cogis Capital. Because remember, withdrawals decrease owner's equity. So that's the D account you're going to do, is the J. Cogis Capital. So after we do that, the only thing that needs to be adjusted is the capital account. If you think about it, our revenues are totally zero. Our expenses are totally zero. Our withdrawals are totally zero. The only thing left, or that was adjusted, is the capital account. Okay? So now it says, prepare an income statement, a summary statement of owner's equity, and a balance sheet for Carlton Tennis Club. So now we're going to look at this T account, or this trial balance here, this adjusted trial balance. And based on this adjusted trial balance, let's do an income statement. So the first thing we have to do is the income statement. If we look at the income statement, we start by showing our revenues, and we basically have revenues from court fees of $678,100. We have revenues from locker fees of $9,600, for total revenues of $687,700. Then we show the list of all of our expenses, and we total the expenses for total expenses of $584,550. So as you see, our net income here is $103,150. We have to do the income statement first, and then from there, let's do the statement of owner's equity. The only accounts you need relate to the net income information from the revenue income statement, and then your capital account at the beginning of the period. You'll adjust your income and you subtract your withdrawals to come up with your ending J. Cogis Capital for the end of the period. Then once you complete your statement of owner's equity, you use that ending capital balance of $520,300 to finish out your balance sheet. So you'll use the trial balance that you see, and based on that trial balance, you'll pull all the permanent accounts along with the information you received from the statement of owner's equity to complete your balance sheet. So basically, the purpose of this is to see how ultimately we create the financial statements from the adjusting entries. And then we're going to basically close out those temporary accounts. And from that, increase our capital with our net income, decrease our capital account with any withdrawals. So as we end tonight, know that I'm going to have some more lectures during this week because I've got a couple more concepts to cover. So I'm going to, follow them with the sequence I have. We're going to talk about something called reversing entries and then a worksheet. Realistically, they will for sure be up on Sunday morning. I will do my darndest to get several of them up before then, but keep checking back and I'll send you all emails. So we've got a couple more things to cover.